Okay, so actually the governor has delivered as the market expected. There is both a rate cut and a change in stance to accommodative. The growth trimming is marginal, not a great deal, but I think the market will take the inflation reduction very, very positively, because that was kind of a clear signal that there is more space to cut rates. Now, 550 as the end rate of the repo rate looks like a given. If anything, it could be more. But growth has not been trimmed so much. Let me straight away get to our experts. Well, just as an added point, not much change in the regulatory issues. Maybe gold loans, we are going to see some new rules. But and co-lending, of course, has been liberalized or going to be liberalized a lot more. But nothing earth-shattering coming over there. Let me get to our experts very quickly. Upasna, what's the sense you're getting? Are you now going to change, from 4 rate cuts to something more? What are the first takeaways?
Latha, the kind of uncertainty that is brewing up globally, clearly the governor has highlighted that as well. Of course, the growth revisions are not reflecting that just yet. But having said that, the kind of emphasis that he has put on the global uncertainties, there is clearly much more room for rate cuts than what earlier we were pricing in. In fact, yesterday itself, we had revised down our terminal repo rate to 5 to 5.25. And just to highlight a couple of things, with the governor having talked about the stance change and providing clarity that, they want to have a clear guidance, they want to be growth supportive, and the stance change is suggestive of more support going ahead. I think these are 2-3 points which are very clear that they will be fairly proactive when it comes to addressing the growth challenges, which will definitely be showing up in the months ahead. So this is something which is very important. On the inflation front, clearly, life is much more simpler, comfortable, because monsoons are expected to be normal. Overall, we are looking at inflation more or less anchoring around 4% handle, with a possibility of a slight downside. But of course, we'll have to see the pace of rupee depreciation and the impact of that. But overall, I don't think there's much to worry on the inflation front. So I would say that the governor has delivered in line with expectations, with a promise to act on a much more proactive basis going ahead as and when the need be.
Okay. Actually, you're right that bringing your repo rate forecast down to 5 and 5.25, because for the better part of this year, he expects inflation to remain below 4%, below their mandate. So I think the guess that the real rate, the neutral rate, can go below 5.5 really opens up, because it's less than 4%. Rajiv Anand, key takeaways?
I think in a world which is so focused on what's happening to tariffs, I think a central government that is focused on growth by cutting rates, by cutting its stance, I think is certainly positive. And I think the governor has also picked up the fact that in this tariff environment, oil prices will be down, US interest rates will be down, and I think that is positive for us from an inflation perspective. So all in all, I think it's growth positive. Yes, assets for banks will reprice sooner than later, but I think you will see a fairly sharp move on deposit rates as well. We've already seen non-retail deposits or CDs reprice from about 8% pre 31st March to about 7% today. And I think now you're going to see retail deposit rates also coming down quite quickly and quite sharply.
Okay, that really was going to be my question to Vinay Tonse. I mean, you will set the tone. Mr. Vinay Tonse, Managing Director, State Bank of India, is also with us. Mr. Tonse, you actually set the tone for the market. As Rajiv says, CD rates have already gone down. Now, do you think deposit rates are on their way down, and how much can you cut them? I mean, your loan rates are going to be 50 basis lower than what they were in January. That's a fairly big impact on your margin. Can deposit rates come down, and how much?
Hi, good morning, Latha and the others. Definitely see, looking at how much of transmission has happened on the way up, if you had noticed, with the 250 points up, the transmission was almost similar, right? But now on the downward trend, as of now, we have not seen much inflation, downward trend on the transmission. But now with the benign inflation, as well as if you look at the liquidity that has come in, right? Liquidity measures that have come in through this, the VRR, the OMO, as well as the foreign dollar swaps. I think now is the time when the transmission will start. And if I can borrow from our ERD report, we will be seeing a similar transmission as what happens in the rate cuts. So this is how it's going to pan out for the banking, which is good.
So, when are you, say for instance, in April itself or in May, where do you expect the deposit rates? Are you expecting them to fall by 25 basis, Mr. Tonse?
When are we, but you ask? Okay, now I think it's not right for me to comment. I will leave it to the ALCO discussions and decision that's going to happen in the next couple of days.
No, I'm not saying your rate. I'm not asking for SBI's rate. I'm just asking generally for the banking system. Rajiv Anand is clearly giving a CD rate.
Yeah, definitely it will.
You mean 25 basis, or it can fall even 0.5% deposit cost?
No, I think 25 now.
Okay. All right. Kaushik,
let us watch out for.
You'll see 25 first? Okay. Kaushik, Upasna says that her now repo rate expectation is it will go all the way down to 5/4 of 5, which means 5 rate cuts minimum priced in. Yours?
Expect repo rate to go down so much. We are not in a crisis scenario. Yes, growth is slowing down. Yes, there is a burden of global growth which could slow down. So yes, we can go down to 5.5, but that could be also through a mix of repo rate cut and liquidity. Remember, today the spread between the US 10-year and India 10-year has fallen to 200 basis points only. So you have to keep in mind that interest differential as well. And you cannot keep on cutting rates if the Fed is not cutting rates. So beyond a point, RBI will also have concerns on financial stability. So I think there is a natural hurdle for repo rate to come down if the Fed is not doing much because of inflationary concerns in their own country because of tariff. The other thing is, if you look at CNH or the Chinese currency, it could happen that over the next few weeks and months, you could see CNH depreciating and going towards 750 or higher than that. So it is very clear to us that India is not out of the woods yet as far as currency risk is concerned, given the Chinese policymakers could use FX as a kind of retaliatory tool against the tariffs that have been put in. So you have to balance growth risks along with financial stability risks. RBI has front-loaded rate cuts, February and April, which is a good thing. They have changed the stance to accommodative, which gives them the flexibility to cut rates, and that, as I told you in the pre-policy call, that they are not going to hike. Therefore, the only options are pause or cut. But accommodative stance doesn't mean that RBI has to come in each policy and deliver a 25 basis points rate cut, because that is how market prices it. There are many other elements which RBI will have to weigh in and then decide. For example, in June policy, RBI may give it a pause, having done back-to-back rate cuts in February and April. So keep that in mind. I think rates can go down to 5.5. But nothing more than that, given unless the Fed is cutting in a big way, which we are not seeing as of now. Let's see what happens with the tariff developments.
Sure. A quick question to the bankers before we move back on to Shobhit and the others. Mr. Tonse, the Reserve Bank of India is saying it is going to review the guidelines on gold loans. Now, we've seen some concerns in the past. We've seen action against one of the gold loan companies as well. What are your broader expectations? Where do you think the concerns could be? What sort of changes are you expecting on the regulatory front when it comes to gold loans?
Hi, can you hear me?
Yes, Mr. Tonse, go ahead.
Yeah, I will actually wait for the evening. The governor also said that the guidelines would be issued today itself. Yeah. Right, but where were the concerns exactly? I think it was about, particularly in some sections of the industry where there was a bit of some breaches were happening, and that was concern for the central banker as well as for the industry. But I would wait for the evening to see actually how the guidelines would pan out. But there is an assurance that it will be a very comprehensive guideline that would be coming. And I think that brings in a lot of harmony.
Sure, but Rajiv, what is your sense? Do you expect some sort of tightening there? What should we expect? The guidelines will, of course, come out later. What's your reading, though?
I think, Ritu, like you rightly said, the RBI has been focused on gold loans from an operational perspective. Remember that gold loans is a very branch-centric business, and so therefore operational risk to that extent is something that the banks need to manage. And I think like rightly said, the RBI has seen idiosyncratic issues with one or two entities, and so therefore they've already done a fairly comprehensive audit of gold loans across the banking system. And I think based on the understanding of that audit, we are going to see guidelines. I think it's better to sort of wait and watch to see what finally comes through.
Okay, sure. Rajiv, the other thing is the co-lending arrangements. So far, the guidelines only spoke about these arrangements on priority sector loans and between banks and NBFCs. Now the RBI is proposing to widen that to all regulated entities and all sorts of loans. What are your expectations here?
I think it's a very positive step. Having said that, it did take the banking system quite some time to get the co-lending structures in place, the technology in place, and getting the right partners to be able to co-lend. But I think the fact that now this is available to assets beyond priority sector, I think is certainly positive. And I think it also gives the opportunity, particularly for NBFCs, to be able to think of this from a liquidity perspective, in addition to what they're already doing. So I think all in all, I think it's a positive measure. Don't expect miracles overnight, but I think over a period of time, we will see this partnership grow.
But Rajiv, do you expect some tightening here, especially when it comes to partnerships with fintechs that we've been seeing with certain banks and NBFCs? Do you expect that to come under the regulatory scanner? Do you expect it to be only extended to regulated entities, so banks and NBFCs only?
I think from what I heard, the governor, I think he mentioned that this will apply to all regulated entities, and so therefore to that extent, the canvas certainly becomes wider. But I think each individual bank will take their call on which entity that they want to work with, because ultimately it is an 80-20, and therefore there is some risk that you're running even in the co-lending space, and so therefore each bank will pick and choose its partners.
Thanks for that. Mr. Tonse, just a one-sentence answer. Are you expecting gold loan rules to get tighter? I think that's what Ritu is driving at.
Tighter but more harmonious.
More harmony. Okay. Well, we don't have a long time to wait. We should get it by end of day. But co-lending will be more helpful, isn't it? As Rajiv says, now you banks have cracked it. So it would mean more lending to the lower ticket kind of loans, because co-lending has been liberalized so much.
Yes, Latha. See, what the benefit I actually see is now this different entities can play to their strengths, right? Because some entities would be finding it easier to raise funds at a cheaper cost, whereas some other entities perhaps have their strengths lying in reaching out to the last mile, or for the strong recovery mechanism that they can have. And this is where the synergies can come in, right? The balance sheets get freed. We have access to lower cost funding as a set together, right? As a partnership. I think this is the best part that comes out, that it is getting extended beyond the priority sector ambit, as well as to all the other regulated entities. Yeah, point taken. I think dissemination of funds or loans or credit should be
better and wider, or so it seems. We will get to know more. Shobhit, thank you very much for your patience. What does all this mean to the bond markets? We've seen, I think, on the 10-year, on the new 10-year, just a 1 basis point yield fall. Obviously, there is this big 4.49% US 10-year yield that is an overhang. But broadly, what's the takeaway for a bond guy?
Good morning, Latha. I think the takeaway for bond market is hugely positive. But for the US market reaction, wherein yields have gone so much higher, our bond yields would have declined far more. So we are held back in a way because of the volatility in the global market, especially on the global 10-year US yields. I think once that settles down, our market will react positively. I think all praise to the new governor. RBI has, clearly shown a shift in strategy, both on handling FX as well as on providing liquidity. I think the proactive measures, the quantum of liquidity which RBI has provided, the transmission this time around would be far better. We would expect yields to go down. I think once the global markets settle down, we'll see bond yields clearly on the downward path.
Oh, okay. Yeah, of course, once the US gives you a little more space. Let me come back to Kaushik. I'm once again taken by what Upasna is saying, Kaushik. At the moment, the real rate is 200 basis points because you are looking at an inflation for the next, 8 months below the 4% mark. So it's a 200 basis point real rate. Do you not think that there is probably, the governor is telling us that there is scope for more rate cuts than just up to 5.5%, or perhaps even a double rate cut at some point, maybe the next one?
I think that is the interpretation that we should be taking. I mean, people can take different interpretation out of this accommodative stance. Way back in February when I did the call with you, I told you that April would be a good time to change the stance. They've changed it, but I also qualified it by saying that that doesn't mean that every policy you have to cut rates or, it has to be a very deep cycle. All RBI is saying is that we will not hike rates from here on, or we are not considering. It can either be a pause or it can be a cut in rates. Now, the question that you are asking, the 8 months real rates would be 200 basis points. Remember that we are going through so much of uncertainty. And what if, inflation in US keeps on staying high? You cannot take such a short-term view. You have to take a little longer-term view and think about financial stability. And also the bigger point, RBI has done back-to-back 2 rate cuts. Now the focus should be on to see how the transmission is happening to the real economy. The focus should be on liquidity, to see the rates actually falling before delivering another rate cut. The central bank cannot keep on giving rate cuts if the transmission is not happening to the extent that they want it to be. So now you have to give it some time for the bankers to reduce the rates. The questions that you're asking on deposits and other things, whether it actually comes down. We know that in May, RBI will give a big dividend. In April, they have already announced OMOs. The durable liquidity is positive. If that leads to short-term rates coming to the SDF window kind of a thing, you already have an effective easing more than the repo rate that is at 6% currently after the rate cut. So I think the time would be, this time RBI should pause a bit, think what they have done, and then what the impact is happening on the real economy. Then look at the GDP number, look at what's happening globally, and then they can do a rate cut in August. And if needed, they can do more. But remember, we are not in a scenario yet when RBI is saying growth forecast is 6.5%. It is still pretty high, and 6.5% and 4% inflation. You cannot just consider for the next 6 months. You have to consider for the next 12 months. And the deeper RBI cuts, remember, there'll be pressure on RBI to reverse it also sooner. And that is not a very good strategy for the economy to be, cutting rates deep, and then within 6 months, if there is a pressure on RBI to reverse it, if something is going wrong on inflation, 6 to 9 months down the line. So I would say cut cautiously, hold it for a longer time so that you give stability to the economy, and the transmission can happen in the meantime for the real rates to kind of get support.
Okay. Very quickly, Upasna, is 6.5 too ambitious as a GDP growth rate? Do you think by the time we come to May, we may get a lower number?
Latha, we remain fairly bearish on the second and the third quarter looks very difficult right now, wherein I think there's going to be the entire impact of this tariff war on growth estimates, which will be felt much more visibly. And we are looking at a range of 5.8 to 6.2% GDP growth, depending on the scale of the problem that will be unfolding over the next few months. And that's why we are much more bearish on the second and the third quarter. Now, having said that, I just want to point out one more thing that, we have seen that in the last few months, rupee has been very volatile and RBI has let it be. In the event of CNY devaluation or consistent depreciation, it is probably in our favor to let rupee depreciate and manage the competitive edge in an environment when the whole world is fighting for with respect to the tariff tensions. So I don't think there's too much to worry yet about, because current account deficit remains well in check. Crude oil prices are there, which will offset. There is scope for probably OMCs to cut the diesel and the petrol prices by 5 to 7 rupees a litre if needed. So there are different cushions that Indian economy still has. And hence, I still feel that having real rates closer to 100, 125 basis is not such a tall task in an environment wherein global growth and hence Indian growth is looking fairly fragile at this point.
Now, what's your growth number?
We are at 5.8 to 6.2. You can say 6% as the midpoint. So we have revised it down from 6.5 to 6%.
All right. Okay. Mr. Tonse, considering that people are revising their growth lower, how will credit growth look like this year, FY26?
Latha, nominal growth rate, say around 10 is what has been the estimate, right? Suppose even if it goes down a little, looking at the normal multiplier, I would say that it would still be in the vicinity of 11.75 to 12. Credit growth.
Right. I just want to quickly highlight for our viewers, we've also got the monetary policy report that the RBI releases twice a year. And according to that, inflation is seen at averaging about 4.3% in FY27, and real GDP growth for FY27 is seen at 6.7%. This is still the MPR. Of course, we'll see how those numbers come out. And a quick word as well on co-lending guidelines. Now, on the gold loan front, Latha, while RBI's discomfort has been clear, on co-lending, I just wanted to highlight, the current rules, which are 2018 and 2020 circulars, only deal with co-lending between banks and NBFCs. Regulations are silent on NBFC to NBFC co-lending, which is very much prevalent in the market. So we'll have to see if the RBI comes out with tighter guidelines on this. Apart from this, there's an older, sort of CRISIL report that says, while co-lending guidelines, of course, deal with priority sectors so far, it says 34% of the 1 lakh crore AUM was in personal loans alone. So I think expect some tightening there, some more, guidelines around which banks and NBFCs can, enter into such partnerships. So that is one of the important things to watch out for. Quick word again, Rajiv, in light of this, for Axis Bank itself, give us a sense of, how large your co-lending book is, if it's with NBFCs, any fintechs, and apart from PSL, do you also have co-lending agreements in other areas or other segments?
So for us, Ritu, we have a whole bunch of partners on the co-lending side. We've been at it for the last couple of years or so. It's not a very big book, but and it is predominantly around PSL.
All right. And Mr. Tonse, for SBI, if you could give us some clarity on the kind of partnerships you have.
Ritu, yes, as I think something similar to what Rajiv was mentioning. We have been having partners for quite some time now, but because of certain integration issues and also our anxieties on underwriting, which would also be around going forward, we need to have the right sort of partner. Otherwise, if going back to the size of the portfolio, it is nothing really to write home about. And we'll definitely be looking at what more we can do with the new guidelines that come in. It would definitely, as I was mentioning, repeating that, it would definitely give a lot of us strengths which we can play upon. I think that's the advantage that comes out of it. Going beyond the central lending.
Okay, Kaushik, quick word, just going through the governor's comments again, where he says the stance provides policy rate guidance without any direct guidance on liquidity management. What do you make of that remark?
So I think what he's trying to say is that just because the rate stance is accommodative, it should not mean that the liquidity stance, when you say accommodative, that it should fall on the lower end of the corridor. Basically, if you say accommodative, then your short-term rate should be between the SDF and the repo rate. So I think what he's trying to say is that liquidity will be sufficient, but don't expect short-term rates to fall on the SDF kind of window, and it will probably stay closer to the repo rate. So the rate stance, the accommodative stance is more in terms of rates, which basically neutral meant that you could consider hiking, you could consider pause, and you can consider cutting. In case of accommodative, it can be only pause and cutting, but don't try to kind of expect that liquidity will be so much sufficient that the short-term rates will fall to the SDF rate. That is what he's probably hinting at. I have to look at it more closely. Our view is that liquidity will be quite sufficient in May after the dividend, and actually you could have a situation where short-term rates could fall temporarily between the SDF and the repo rate. Let's see whether RBI allows that or not. But the point that you also made about the NPR report and the question that Latha was asking, that how do you look at real interest rates, because the next 8 months is looking very good on inflation. Therefore, real rates would be more than 150 basis points if you don't cut below 550 or lower. My point is, when you're doing monetary policy today, you're going to look not just for the next 6 months, you're going to take the next 12 months into consideration. And that's where the FY27 forecast that you talked about, inflation at 4.3 and growth at 6.7.
6.7, yeah.
Yeah, unless they revise it down at those kind of growth estimates, you're not supposed to have repo rate coming down to 5%. That's my limited point. Now, if the growth forecast itself changes because of global economy going into recession, and in October, they'll present the NPR report again. Over there, if they mark it down, then you can talk about terminal repo rate going down to 5% or 5/4. But with this kind of forecast, I don't think it goes down below 550.
Okay, Upasna, in light of the monetary policy report's forecast on inflation for FY27, 4.3, GDP, 6.7%, are your expectations of what the terminal repo rate could be also get changed?
No, I think, Ritu, what we need to keep in mind is, like Kaushik said, I agree. With the current forecast, you may consider this as a tall task to get the repo rate terminal closer to 5.25. But as I said before, we are expecting 6% growth in FY26, and we will be probably closer to 6.25 only into next year as well. And that is the reason we believe that the terminal rate will be lower, closer to 5.25. We do believe that there's a significant downside to RBI's GDP forecast, both for FY26 and 27.
Okay, thanks for that, Upasna. It clearly looks like the market is convinced that the gold loan rules are getting stricter. I mean, there's a fairly steep fall in all the gold loan stocks. Can we just bring up Muthoot, Manappuram, and maybe even Catholic Syrian Bank, CSB Bank on the screen? There seem to be sharp cuts. What is your sense, Rajiv? The market is guessing right? Stricter rules?
So I think one of the things, Latha, that is possible, which is what the market is perhaps worried about, is the LTVs. LTVs for NBFCs is higher than banks, and I think the governor spoke about aligning across all regulated entities, and so therefore perhaps the market is assuming that LTVs for NBFCs, which I think, if I'm not mistaken, is 75% today, is 90% today, will go to 75% like all banks, or all banks and NBFCs will be at 90%. Okay. So I think perhaps that alignment of LTVs is what the markets are worried about for NBFCs.
Mr. Tonse, you want to add to it? The stocks are falling, so I think the market is guessing like Rajiv is. Your thoughts?
You remember what I said a little earlier, that I would rather wait. I think the markets also should rather wait for the guidelines to come before, deciding either way the direction they take, right?
Okay. Your job is to lend loans after you look at the rules. The market has to take a position before the news. You always buy the rumor and sell the news. In this case, I think they are selling the rumor and probably will buy the news. We'll have to wait and see. But there is a bit of a worry, and I think there could be a justification because gold prices have run up very high, run up very swiftly. So loans given at this juncture, in case the inevitable happens or the expected happens and gold prices peak off, then at 90% loan to value, a lot of gold companies could be finding their collateral shorter than the loans they sent. Maybe that's what they're thinking about, but all this is guesswork. Let me tell all our viewers that, like Mr. Tonse, we are also waiting for the rules and we're just trying to read through from the stock prices whether the rules get tighter, and Rajiv's guess seems to be a very good one. I think we can wind up on the special monetary policy broadcast. Shobhit Mehrotra, any last words in terms of a bond dealer? Anything you want to ask the governor?
Well, I think governor has delivered as per market expectations, no doubt, in terms of providing liquidity, in terms of a competitive stance, rate cut. So I think all expectations of the market have been met. This time around, I think transmission would be far better. I think we just need to be patient with letting global markets settle down in terms of the high degree of volatility which we are seeing, and thereafter we will see fairly good decline in bond yields and overall market performing as per expectations.
Okay. Thank you very much, Shobhit Mehrotra, Vinay Tonse, Rajiv Anand, Upasna and Kaushik for parsing the monetary policy with us and helping us understand it better. As Ritu and all our guests have been saying, the governor has delivered exactly as the market wanted. A rate cut would not have been enough. A rate cut plus a stance change has certainly made the market happy. And we have to wait and see what the regulatory rules are. One of them looks like it furthers dissemination of credit, because you don't have to do co-lending only between banks and NBFCs. You can do it with NBFCs and NBFCs, or so it seems. That's what the new rules will say. And you don't have to only lend priority sector loans. You can lend all kinds of loans. So this is something the market will be very happy about, especially NBFCs. But I think one of the points that we have not mentioned in terms of the ultimate positive that comes from this statement is that it is very short. We normally have 17 points in the monetary policy statement. This one, I think, has only 7 points. So 100 marks for brevity for the governor. That's it on this. Okay, it's not 7 points, it is 9 points. But the last one is just announcing when is the next monetary policy. So 100 marks for brevity for the new governor. That's it on this special coverage of the monetary policy statement. But this is part 1. You will have part 2 of the coverage starting at 12, when the governor will address the media and take press questions. And we will have guests joining us to parse the statements that come out from the press conference. That's at 12 o'clock. From me and Ritu, thank you very much for joining. We'll see you at 12.